Hello, it's high time we talked about a massive giant, a very, very well known company throughout the world, McDonald's. This is a company that had its IPO days back in 1966, absolutely insane. More than 100,000 employees, massive company, everybody knows about it. So let's jump into it and take a look at what the company is doing financially. First off, we're going to start with our stock analysis chart here, just to see what's happening with the company's financial metrics. And you will see here in the last month, the company had a little bit of a downturn and then started trending up again. So the 3-year period when it was $170 at its high, and right now it's again sitting at 248, almost 249 over here. So massive increase actually in the last 3 years. So people who bought actually made some decent money there. In terms of its max chart, you'll see it going back many, many years, 1966 pretty much, as we already examined. And the company stock price over here was really, really low, few cents. So if you bought here, you're probably a massive multi-millionaire right now, but if you're still alive, that is. So right now, if we take a look at probably the 1-year chart would make some sense. You will see that we are sitting at kind of relatively close to the highs of the company, of the stock. So we should be careful about whether it's actually worthwhile buying here. It was different buying here, it's different buying here. I mean, it's a little bit of an increase right now. But let's take a look at the financials and see what makes sense. The P ratio of the company is sitting at 24.8 right now. That's a little bit more than what I would like for a company like McDonald's, because this company is not a growth company. This is a company that we know what it's doing. It's a big business. It's not really growing that much. It's a steady company that's producing cash flow pretty much. And so I want to be getting it at a lower P ratio, much, much lower, really, probably something in the range of 10 to 15 potentially. Same thing with the price to free cash flow ratio. So that already is a little bit of a bad thing for me. Now the outstanding shares, though, the company has been buying back shares. Okay, so they are actually helping investors a little bit. That's the 5-year purchase period. That's fair, 6%. And the free cash flow to total liabilities ratio, it would take about 8 years of last year's free cash flow to pay all the total liabilities that the company has. That's a little bit too much. We typically want 5 years, but I can understand it from a company like McDonald's. They are notorious for doing that. This is why you're looking at negative equity growth here. That's a very, very well-known thing about McDonald's. They take on a lot of debt, and they basically are relying on their ability to produce free cash flow to run the business and to pay that debt without having much issues. And I'm fine with that. That may be worrying to some people, and for this reason I kind of wanted to play you a little bit of a snippet of a discussion that, actually an interview that Warren Buffett had when he was asked about negative equity companies. And this is what he had to say. Let's take a look at this and we'll be back at the analysis here.
Yeah, I don't think there's anything magic about whether shareholder equity is positive or negative. The Coca-Cola has a shareholder equity of $5 billion. It has a market value of 75 billion or so. Now, they're not going to do it, and I'm not going to recommend it, but if they were to spend $10 billion buying in their stock, they would have a negative shareholders equity of $5 billion. Their credit would be sound. I mean, if somebody else were to buy the company for $75 billion, they'd have $5 billion of tangible assets and $70 billion of intangible assets. And there is nothing magic about a company having a positive shareholders equity, and it isn't done very often, and I can't even think of a case where it's been done, but it may have been. But I see nothing wrong with a company having a negative shareholders equity, although it may be prohibited by the state in which they're incorporated in terms of repurchasing shares at a time that would produce that. You have to look at the state law on that. But any time a company in an LBO or something is bought out at some very large number over book value, in effect they're creating a negative, if they borrow enough money on it, they're creating a negative shareholders equity in terms of the previous shareholders equity. It's just a fiction as to the numbers between the two organizations. Now, you should buy in your stock when you don't have a use for the money, and that could be management specific. I mean, some managements might have a use for the money if their field of capital allocation were large enough, whereas another management that was more specialized in their own business might not. But once a company has attended to the things that are required or advantageous for the present business, we think reacquisition of stock is a very logical thing to consider, as long as you don't think you're paying more than the intrinsic value of the business in doing it. And obviously, the bigger the discount from intrinsic value, the more compelling that particular use of money is.
Okay, so you kind of see now why you shouldn't be too scared of this kind of thing, the negative equity. In some situations, it can be bad, but if we're talking about a company that's making good free cash flow, I wouldn't be that, I wouldn't be that appalled by it. And this way you see like a terrible return on equity here again. Again, this is not a thing that should really deter you from buying this specific company. But if we're talking about a company that's losing money, then that's a different thing and you should avoid it. Now let's take a closer look here. And what I want to see is the financial statements of the company. I want to see how they are doing in terms of their growth and everything. So the revenue growth, as we mentioned earlier, has been up and down. And generally speaking, you will see that it kind of balances itself out. So this was $22 billion, 23 almost in 2017. And it's again the same thing in 2021. So we're looking at a company that's not really growing. It's doing the same thing every year, more or less. And so the net income of the company kind of follows the same pattern, although in the last year, 2021 fiscal year, the company actually massively increased its net income. So that's actually a big increase. Good EBITDA growth here. They actually increased. Less depreciation and amortization is a thing as well. So they did increase their net income that came in. Now next year actually could be similar to this, so I wouldn't be surprised if this happens, or maybe even this. But again, this is a company that can go a little bit up and down, but you wouldn't expect it to go like too low or too high, really, very, very soon. And so if we take a look at the balance sheet, again, we will see negative equity here. We talked about it. This is a thing that happens with McDonald's. They take on a lot of debt. You'll see it here. But they do make enough free cash flow to be fine with that. They do make a lot of free cash flow. And this is the way they operate their business. So I don't think you should be any scared about McDonald's potentially going bankrupt, though. You will see here that the company's actually, let me go higher. The company's cash from investing activities has been, for the most part, negative, which is a good thing. And apart from this year, which means that the company has been spending some in capital expenditures and some acquisitions here, for the most part, and also paying some dividends, which we haven't examined yet. We will. And pretty much, the free cash flow is increasing. So that's the most important thing, not really the equity. And now if we kind of go back a little bit and we go back to our stock analysis tool, our stock analysis chart, basically, you will see here the dividend payout ratio on the very bottom, which is sitting at 52%, and the company is paying 2.14 in terms of its dividend yield on its current stock price. This is close to what I want it to be. I typically want it to be less than 50%. 52 is sustainable, I think, for now, especially if the company keeps producing a good net income and free cash flow. It's a little bit more than what I would like, but it's probably sustainable for a long period of time. So I wouldn't be too worried about it getting a little bit of dividend from this company if I were to own it. Okay. And finally, there is no company that's a good company if we have to pay a lot for it. So we need to know how much we should be willing to pay for the company, because the company is great, it's making good free cash flow and all that, but how much are we willing to pay for this? And so we have to go with low revenue growth, of course, because the company is not really growing much. So 1 and 2 and 3% is what makes sense here. Now the net income margins are fairly stable. Again, you would kind of expect that. I'm gonna go 22, 25, 28. Free cash flow margins, again, predictable. That's a very, very good thing. I like to see that. 70, 80, and 90 makes a lot of sense. And 13 is what we typically use for our annual return. And so let's hit calculate. And what you see here is that despite the company being amazing and it's producing good free cash flow and generally speaking being a very very well known company, you may have heard that you should be buying companies that you know, that you use and all that, and that's a correct thing, that's a good thing to say. But you should be buying these companies, and what I should add to this one, you should be buying these companies when the stock price allows you for it and it actually makes sense for. And so in this case, we're looking at high estimates that are far, far below our current stock price, pointing to a company that is very, very overvalued based on what it's actually currently doing financially. So while I like the company, I wouldn't be investing in it right now. I think it's expensive. And this is the whole point of this pretty great tool here. It can actually really quickly tell you whether a good company that you have already analyzed with a stock analysis tool is actually worth your money right now. It is worth your money, generally speaking, but less money. That's the thing. And as an investor, the most important thing is not to be overpaying. Two things really: buying great stuff and not overpay, underpay is what you want to be doing. So it's not only about finding great companies, it's also about finding these great companies at low prices. So thank you for watching the video. I hope you enjoyed it. I hope it helped you a little bit. I'm pretty sure a lot of people are looking at McDonald's. I think I used to own I definitely used to own them at some point. I think I sold some time ago. So if you did like the video, please remember to like and subscribe, because at some point I will give you access to this tool and you will be able to do it yourselves. So you may want to stay around for when this happens. And if you did enjoy this video, take a look at the fallen giant, which is GoPro. It starts to look a little bit interesting right now. So this is an analysis for the stock. And thank you for watching again. See you in the next one. Bye bye.